Okay, hello everybody. Welcome to Korean Atlanta Mentorship. Happy Thanksgiving. I can't believe it's already the end of November. That went by pretty quick. Just making YouTube videos and clickbait thumbnails and doing velocity banking for the whole year. And we're going to celebrate Thanksgiving, a debt-free Thanksgiving. And I'm going to be honest with you all, I actually don't like Thanksgiving. Okay, I know a lot of people are really excited with the turkey and all that. Um, but you know why I don't like Thanksgiving? It's because it's not what it used to be. Like, I feel like nowadays, when you're physically with people, mentally they're not there. So if I want to go ahead and enjoy a meal and just talk with people, I can't do it anymore. You know why? It's because people are stressed. They're stressed because their paycheck isn't going as far as it used to. And not only that, they just have a lot of debt, right? So, to get started with today's video, which is another Velocity Banking review, I asked ChatGPT, how thankful would most people be in the US if they were enjoying Thanksgiving dinner debt free? And let's go ahead and read the response.
Most people in the U.S. would likely feel an immense sense of gratitude and relief enjoying Thanksgiving dinner while being debt free. Debt is a significant source of stress for many Americans, and being free of it would allow them to focus more on their blessings and loved ones rather than financial burdens. This scenario might amplify feelings of thankfulness for the freedom to allocate resources toward goals like saving, traveling, or helping others, the emotional peace that comes with financial independence, the ability to fully enjoy moments like a holiday dinner without underlying stress. For many, achieving such a milestone would symbolize hard work paying off and could inspire them to reflect on how much they've accomplished and how far they've come. It might also motivate them to share their experience and strategies with others.
Right, and this one, I think, reflects the kind of Thanksgiving I would like you to have to enjoy the moment, with the people around you so that when people are physically there, they're also mentally there as well, right? And one of the reasons why people aren't mentally there is because they are stressed. But how are we going to relieve that stress? By paying off our debt and doing some velocity banking. So let's go ahead and get started for today. So, um, we're going to do velocity banking. And what's velocity banking? All it is a debt payoff strategy using your line of credit as your main tool to pay off debt. Okay? And so we only need two things. Number one is a budget, and then number two is a line of credit, and we're going to use that as our main operating account. So what's a line of credit? All it is a financial tool where you could borrow money, pay it back, and use it over and over again. And it's really simple. Like people overcomplicate this to I don't know how humans overcomplicate things that aren't necessary to overcomplicate, right? You can easily do a budget, right? So many people were like asking and begging, and I got sick of the comments like, give me the spreadsheet, like you can do it yourself, but because I don't want to see any more of those comments. I just uploaded one for free that you can use in the YouTube channel page somewhere, right? So here we have the average American. We have income, we have expenses, we have leftover savings. And when you do an expense breakdown, okay, you have to list every single debt that you have because this is a debt payoff strategy. So we have three credit cards, an auto loan, a student loan, a mortgage, and then these are what you call your general expenses: food, gas, insurance, things you always have to pay for. No matter what, whether you're paying with a debt or in cash, you still have to pay for it, right? Whereas all of this, because we took out debt, this is eating into our cash flow, but debt is if you think about it in a way optional, right? Like it's not mandatory. In fact, if you ever study like real estate investing, they come up with terms like NOI versus cash flow. What is NOI? It's the income that you receive without debt, and then cash flow is the income you receive after your debt service has been paid off, right? And so our whole goal is to increase our cash flow and make sure all of this debt goes to zero, okay, with the help of a line of credit. So we assume two things: same income, no savings, all right, and we're going to have the same expenses, right? Now, if you make more income, that's fantastic. In fact, I actually make about $300 to $500 a month just by doing these Excel spreadsheets on YouTube. I just talk and talk and talk, and somehow YouTube makes me money. Isn't that cool? And so now we need a line of credit, but here's the thing. if you're making money and you only have $242 left over after each month and you got all this debt, no lender is gonna lend you a line of credit. And I speak as a person with over $527,000 in lines of credit. It's my credentials. There are other people on the internet that have more than me. I think Credit Plug has like 2 million. Maybe that's the last time I remember he said when I watched one of his videos, but maybe he's got more. I don't know. I have 527,000. When I show that to people in real life, they think I'm insane. Like, why do you need all that credit? Oh my goodness, right? And the reason why we need all the credit before we ever need it is because banks don't lend money to people who need it. Banks don't lend money to people who need it. So here's the thing, if you're a person who needs money and you try to borrow it, what's the likelihood you're going to pay it back? Almost zero. The banks know this. They've been in business for many, 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 many years with hundreds of millions of customers, so they have the data to understand who is our best customer. And you wonder, when you go to every single downtown in the United States, why are the buildings so tall? You ever watch like the Family Guy Chase commercial, where it's like Chase, Chase Bank, how did they get that new stadium right there, right? Because they're smart and they understand that they're not going to lend people money to people who need it. Their best clients, people who make money but are just kind of bad at managing, kind of like this guy, the average American, right? And so what we're going to do is assume that yes, we did get a line of credit, but the whole point is that hey, if you knew this strategy, you won't even get here. You know what I mean? That's what it is. And I know for a lot of people, it's actually a lifesaver. The only time you will get a line of credit is if you got it way before you need it, and usually when you use it wrong, you know what happens? This gets maxed out. I've seen people send me their spreadsheets, their budgets, where it's like they already have a line of credit, but they just treat it like another maxed out credit card. And that's not what we want to do when it comes to velocity banking. One of our main goals is to prevent the segregation of income, right? We are not going to segregate our income. You might say, what does that mean, right? So basically, with the average American, when you get paid, right, your paycheck, your $6,000 gets split into many different ways, especially with the debts, like one, two, three, four, five, six. So six different ways with your debts, and you're essentially making minimum payments on everything, and then you kind of have your additional expenses of food, gas, insurance. Now, not only that, you need a savings account, right? So this is how the banks get you, is to make it feel like you're irresponsible for not having savings account, and this is reinforced by what you call the cultural matrix. So if you ever tell your friends or family, like, go to your Thanksgiving dinner today, oh, like, I don't have a savings account, like, oh, I don't save any money, they'll act like you're insane, like, how do you not have savings, what if in case of emergencies? But in those cases, that's what our line of credit is for. It's our main operating account. It's where we put our entire paycheck. It's where we take our expenses, right? That's what we mean by our main operating account. And if we have additional savings or emergencies that we need, we just pull out of our line of credit. Okay, we just pull out of our line of credit. So let me just kind of show you this, right? I always like to show this because this is my time to flex, right? I'm literally flexing physically right now, but although I don't have my cam on, I got big financial muscles. I see them right there. I'm gonna kiss my big financial bicep. Man, that's beautiful, right? Okay, so here's a screenshot of my home equity line of credit. And the cool thing is that with apps, banking apps nowadays, they always have like that quick balance feature where you just swipe up and then you can just like quickly show the balance that you have, right? I really wish that mortgage brokers and would like take that as like, proof of funds, you know what I mean? I don't have to get an official bank statement balance and put it in a checking account. Oh, that's so painful, especially when I have to literally take out money because I don't have any down payment, and then it's like costing me 8% interest like for a month. Oh my goodness. Okay, so but don't do that, right? That's ridiculous. But and also don't listen to anything I say because I never give financial advice to anybody. All right, so here is my home equity line of credit. So it's a $280,000 home equity line of credit, and you might be like, what? Why is this so huge? Sometimes other people tell me that too in different contexts, but we're going to talk about the home equity line of credit. And so, um, yeah, the reason why is because I don't need money. And if you understand the game of banking, right? It's kind of counterintuitive, right? Because a lot of people, believe it or not, only go to the bank when they need money. And how do I know this? Is because the banks actually reject 90% of their applicants when it comes to credit. I know this is for sure true when it comes to business credit, and I think this is true when it comes to mortgages, but 90% of people don't qualify for mortgages in the United States. Is that crazy? Like how like they only do a small percent do business with a very small percentage of the population, and then out of those small percentage, they essentially, I don't know if taking advantage is like the best way that you could think about it, but if you just kind of type in 2024 home buyer regret, what percentage, it's going to be some ridiculously high number. Regret buying a house, 90%, 90%, right? Majority of millennials have home buyer's remorse, so it's just like as a bank, you're only doing business with a very small percentage of the population that have money, and then you just hope that they're just bad at managing it, right? Like you're just hoping that they're segregating their income. And I've had plenty of people who make like over 10 grand a month, or I don't want to say plenty, maybe like three people who make over 10 grand a month, and they're doing what the bank wants them to do, which is segregate their income. So we're going to prevent income segregation. And so now what we do is we move some of our debt to the line of credit to make it our main operating account. And then the next step is we put our entire $6,000 into the line of credit and the expenses out, and we are going to try to maximize this thing called cash flow. So let me go ahead and move some of this credit card debt, right? So this is $52,000 of credit card debt. So if we kind of do it, think of this as like a balance transfer in a way, credit card balance transfer, although technically that's not true, but it's similar. So this now becomes zero. This now becomes zero. This now becomes zero. What? How did we go from $242 to about $1,900? Oh my goodness, this is insane. $52,000. Wow, I can't believe it. Like I just transferred $52,000 into a line of credit, and somehow my cash flow jumps up to 1,900 a month from 200. Can you believe that? I can't even believe it, man. All right, so now the next step is to put our entire paycheck in. So instead of making the minimum payment like most people do when they have a line of credit and treat it like another credit card, we put our entire 6,000 in. And then we have bills to pay, whether it's the auto loan, student loan, mortgage, or our general expenses, we take it out of the line of credit. Now, technically, I actually don't pay for my general expenses with the personal or home equity line of credit. I pay it with a credit card, right? And then once the statement balance comes out, which is going to take about a month or so, and then they give you like I don't know, almost another month to pay it off in full. Then that's when I take it out of the line of credit, right? Lines of credits are really cool. In fact, I actually did a quick training on this of what the advantages and disadvantages are of credit cards and lines of credit. And a credit card technically is a line of credit. And actually, let me just do this. All right, and we're gonna make this like white font. Okay, so disadvantages and advantages, and I use both, right? Because you want to get the best of the both worlds right here of why you would use a credit card versus why you would use a personal or home equity line of credit. And did I go over the definition of a line of credit? I don't even know, but I'll say it one more time. What's a line of credit? All it is a financial tool where you could borrow money, pay it back, and use it over and over again. And right now, I have like I think 21 or 22 credit cards, and I have over $527,000 in lines of credit. Right? You saw that huge 280,000 home equity line of credit. I got like a 15,000 personal. I think I got an 800 personal as well. I mean, I might as well close that one. That one's embarrassing. It's embarrassing, right? Like I see that one and I feel like Gordon Ramsay when he goes into a restaurant and says the food is raw. That's how I feel like when I see that $800 personal line of credit. And the most embarrassing thing about that is that the bank doesn't even let me withdraw the money at on like non-business days and weekends. It's like that is the worst line of credit I've ever dealt with in my life, but it's all good. Okay. So let me kind of go ahead here. All right, so let me just kind of go ahead here. So this is all right, so this is not the budget I want. Let me move this. So this is the budget I'm working off. So here's the thing. When we make that $6,000 pay into that line of credit payment, that satisfies a minimum monthly payment, and it lowers the interest because the interest is accrued on the average daily balance. So let's go ahead and do this. I2 plus 1. And then now this is G2 plus H2 minus 1934.8. 0.81. So how do we get the next month's balance? We get the previous month's balance, previous month's interest, and then subtract our cash flow. Paycheck comes in, expenses comes out, and on average, on every single month the balance will reduce about 1900. And then what we do is we take the interest, right? We calculate the interest based on the average daily balance. That's a way to calculate it, right? Average function. Multiply it by 0.8 and then divide by 12. 0.8. 0.8 divided by 12. Okay. So 8% is the annual interest, and then you divide by 12. That's when it gets calculated monthly. And let's go ahead and copy and paste all of this, all of it, right? And then we could see that we're destroying the debt, right? Okay, so we see that in month 30, so a little bit over 2 years, less than 3 years. Okay, that $50,000 debt is pretty much gone, right? It's pretty much gone. All right, so now let's get excited about this. And all right, and so 30 months to pay off 52K. 52K. All right, cool. Copy, paste. And then now, well, did I even paste it? I didn't even paste it. Okay, copy and paste. That's our milestone. And then now we have these three other loans left, right? And so if you don't know this, there's actually one of the most important things that I think is neglected in velocity banking teachings is the concept of debt payoff order. So if you don't pay off the debt correctly in the right order, you could just kind of be throwing away interest to the bank. And this is why, like, first lien HELOCs, every time I do a calculation where people like on the internet are like, you should replace your first lien HELOC, or I'm sorry, with your 3% mortgage to first lien HELOC. And you know what the crazy thing is? Someone actually wrote in the comment, I did exactly that and now I regret it, right? Right? So I don't even know what to say. Like I don't want to say like tough luck, buddy, but it's almost like wow, maybe I should. This is why you kind of need to go hardcore in your marketing because there are people who could use this information, and um, unfortunately, not it didn't reach the people who needed to see it in yeah, that's unfortunate, right? I kind of feel sad about that, but it is what it is, right? So let's go ahead and take a look at our loan calculator. Do you know that I created this loan calculator, which is kind of a copy of the financial calculators that they have, like HP Financial Calculator 2B or something like that. And yeah, this 10B2 financial calculator. So there's like these buckets and functions that that kind of allow you to calculate like, hey, if you have like these three, then you calculate the payment month, and then like you calculate the current balance. And I actually took an 8-hour class on this just to kind of figure this out, and that's why like I'm so proficient in doing this stuff. And so Excel has these functions where you could literally just like generate a payment like from an amortized loan, a payment amount, and figure out the current balance. Isn't that really cool? So now this is what we're gonna do. We're gonna put in the what's it called? The current balance, right? The current balance of the auto loan. And here's the thing, because this auto loan has a 12% interest rate, I probably would have just like put it in the line of credit, right? I don't know if it would have fit 69,000. Yeah, you know what? Let's just do this because right. So let's move these high interest rate loans into the line of credit. So I'll just do this, okay? And then so this is going to be 60 52 plus 17, right? Let me make sure I did this right. Plus 17,000. Whoopsie. Because 17000. Okay. All right. So let me just kind of reset my cash flow here. I want to see if it makes really a big difference. 2312. Now I'm just curious. 96. Okay. And we're going to go ahead and see if we even pay it off faster or not. Well, we probably won't, definitely won't, just because we added a loan there. But, okay. All right, so 34 months. Let's just do that. So 34 months to pay off, not 52, 69K, right? So I think we can include the auto loan just because in my experience, when you include a loan that has a higher interest rate than the line of credit, you usually save money. The thing that doesn't work in my experience is the mortgage. When you move a low interest rate mortgage into a high interest rate line of credit, I've never seen that work ever, right? Just from my experience, and I'm not going to go over that too much right now. But let's go ahead. So we defeated this monster in 34 months. So this is now 0, right? We just kind of decide to um, move it in the beginning. But take a look here. So now the current balance is 25 grand. If you've never heard of the cash flow index, I kind of think of it as a ranking system of which debt to pay off, right? So this 69, what does that represent? Well, that's a number that's coming up a lot in this video. But what does it represent? It's just how much bang for our buck do we get for paying off the loan. So if I pay off the 25 grand, right, I get about 360. So would you pay 25 grand to get the 360 back in your cash flow, or $211,000, 211 grand to get 1,300? I'm certainly going to pay this one off first just because I get more bang for my buck. And so in my experience, right, if you have a cash flow index that's higher than 50, I think it's somewhat safe to move it to the line of credit, although what we call the chunking method, which I'll explain in a little bit, is probably a lot more optimal, especially if you're dealing with lower interest rate loans and trying to pay them off with the line of credit. Okay, so I'm going to go ahead and go back here and we'll move this into a line of credit, meaning that we just do a debt transfer again to that line of credit. And one of the most important things we always have to memorize or not forget is that the debt payoff order is incredibly important, right? So let me go ahead and copy and paste this. So so we did that. And so 34 months. Now what's our new cash flow? We get an extra just $300 in our cash flow. So now it's 2680.99. So 2680.99, right? And then now let's go ahead and copy and paste. Okay. And right. So in 44 months, we got that student loan paid off. Remember how everybody's like, student loans? Man, they're going to last with me for the rest of my life. And everybody's doing those income-based repayment programs. In fact, I kind of did like a velocity banking video about law school students, right? And I'm curious, okay? Now I'm curious. Um, do most law school, well, actually, how about this? What percentage of law graduates do you think are heavily considering income-based repayment uh, programs for their student loans? 63%. Oh my goodness.
A significant percentage of law graduates are likely heavily considering income-driven repayment (IDR) programs for their student loans, especially given the high cost of legal education in the U.S. The exact percentage can vary, but some estimates and trends suggest law graduates in debt. According to the American Bar Association, the average law school graduate in 2022 carried over $150,000 in student loan debt. Rising interest in IDR. A 2023 survey from the AccessLex Institute found that about 63% of law graduates plan to use or are already enrolled in income-driven repayment plans, as these programs provide more manageable monthly payments based on income. Reasons for the high interest in IDR programs among law graduates include: 1. Delayed financial stability. Entry-level salaries for lawyers vary widely, and not all graduates secure high-paying positions. IDR programs help bridge the gap for those starting with lower incomes. 2. Public Service Loan Forgiveness, PSLF. Many law graduates pursuing careers in public interest law or government roles aim to qualify for PSLF, which requires enrollment in an IDR plan. 3. Flexibility and safety net. The structure of IDR plans offers a financial safety net, ensuring payments remain affordable even in periods of unemployment or underemployment. While not every graduate relies on these programs, their popularity continues to grow due to the affordability challenges in higher education.
Wow, right? So what was the whole point of that? People like take out these insane student loans and they struggle with them. And so the thing about like income-based repayment programs, right, is that what they do is lower the payment, but the interest still accrues at what it would be. So if the interest is like let's say $500 a month and then they make the payment like $200 a month, that additional 300 just gets added to the loan. So that's why there's a lot of people who are surprised. Like I thought I owed $150,000 on this, and then they do an income-based repayment program, and now they owe 200,000 or something like that, right? So we're just better off paying off the debt, and we did it in 39 months. We're not law school graduates, but 33K. I don't know if that's a lot to be honest, but better off going to community college where it's super cheap, right? I remember like the tuition every year was like 5K in a local community, like prestigious community college in Southern California, and it's like, dang, I'd just rather go there than like Prestige U where it costs so much. You know what I mean? So 39 months and 44. Oh, I'm sorry, no, 44 months. 44? I'm getting confused now, and it's probably because it's Thanksgiving. I should be relaxing, but it's all good. All right, 44 months. And then this is like 69 plus 33, right? So it's 102K paid off in about 44 months. All right, not bad. Okay. Now the next thing is the mortgage. Okay. Now let's go ahead and put in 44 months in our loan calculator. So this is now 0. Now let's think about this. How much of the principal did we actually pay after 44 months? And what is 44 months? It's actually 3.6 years. So in 3.6 years, 44 months, we paid off equals 220 minus 209, right? About 11K of your debt, of our mortgage. And look how much interest we pay. We pay about like 4 times the interest with the 6% mortgage. And so if you want to know why like a lot of companies like it when you refi, there's a reason why they send those refi letters is because not out of their grace goodness like their or charity, they know that they're going to make money off of the refi, right? Whether it's just the brokerage, the loan fees, right? And because most of the loan is interest in the beginning, if you don't pay it off early, you're just going to restart the loan and just keep paying interest, which is how banks make money, right? Like, in fact, let me ask this. How much money do you actually, can you quickly estimate how much a bank would spend on a marketing program, on marketing, let's see this, marketing to get people to refi their house? $1 million in direct marketing costs for a mid-sized bank, and then a larger nationwide bank, 5 to 20 million. So it says why the investment? Because they aim to make significant profits from refinancing through loan origination and interest rate spreads and potential selling opportunities, right? And let me read this out loud for all you
Estimating
audio
how much a
learners.
bank spends on marketing to encourage people to refinance their homes depends on the scale of the campaign and the bank's size. But here's a quick breakdown. Key variables to consider. 1. Marketing channels. Costs vary by channel, digital ads, direct mail, TV, radio ads. 2. Target audience size. A local campaign costs less than a nationwide effort. 3. Cost per lead, CPL. In the mortgage industry, CPL often ranges from $50 to $300, depending on the competitiveness of the market. Example calculation. A mid-sized bank running a digital campaign targeting 10,000 potential leads might spend $100 per lead x 10,000, 1 million in direct marketing costs. For a larger nationwide campaign involving TV, digital, and mail, Total costs might range from $5 million to $20 million per quarter or campaign. Why the investment? Banks aim to make significant profits from refinancing, typically through loan origination fees, interest rate spreads, and potential cross selling opportunities. The potential revenue from even a small percentage of successful conversions often justifies the hefty marketing spend.
Right? So you think like, oh, I just got a letter in the mail. The bank spent millions and millions of dollars for you to get that innocent piece of mail so that you can refi. Isn't that crazy? Okay. So let's go ahead and make sure that we pay this sucker off, right? And so 11K, let's just do this. Let's move 11K from the mortgage into the line of credit. So we're just going to go down here. And remember, we're still making the monthly payment. We haven't paid it off yet. So our cash flow does not actually increase. So let me just kind of put in 11K plus 11000, right? And see how long it takes to pay it off. Holy bazookas, it's only took us 4 months to pay off 11K. So 1, 2, 3, 4. Let's rinse and repeat again. Put another 11K, right? Holy bazookas, that was easy. Oh wow, every four. So literally 1, 2, 3, 4. On average, every 4 months we pay off that 11K. Okay, on average, right? So if we take a look here, so 44. So in 4 months, so 44 months, we paid off 11K, and in 4 months, with the help of a line of credit, we paid off 11K, right? And these are just cowboy math estimates, but you kind of see that if we do this in 44 months, doing what we do, we could pay off $110,000 of debt easily, right? You see that? Like we do 44 months with our line of credit, whereas if we're doing what we do with the bank schedule, right, especially in the first couple of years, we're not paying that much in the actual balance of the loan because all of it is going to here, which is the bank's interest. Okay. All right, so let's go ahead and open up the Velocity Banking Calculator where I just type up these numbers and shoots me a number. Because the thing about this is that you can kind of estimate it, but because you're making that monthly payment while you're doing this, that also affects your payoff time as well, right? So let me go ahead and open it up. All right, there we go. There's our Velocity Banking Calculator. All right, awesome. I just type in the numbers. It's so cool, right? And just spits out the number of years and the interest. And I got this from Renatus, which is where I originally learned velocity banking from, right? And so, believe it or not, this YouTube channel is kind of like a sales funnel for Renatus, and I make commission off of it. So if you want to give me the money, right? Give me the money because I'm going to be in foreclosure tomorrow. You need to help me pay for the Renatus education. No, I'm just kidding. No, that's actually a joke, but not really that funny. But I do make commission off of selling their products. So if you're interested in not only learning about velocity banking, but also, um, financial literacy topics, real estate investing, blah, 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 fill out the Google form link below. That's my quick plug. Okay, so let me go ahead and just demonstrate one thing. So a lot of people get confused by this chunk amount, like what the purpose of it is. And they actually think because a lot of VB teachers say this on the internet that you should just replace your mortgage with the line of credit. And the bigger the chunk, the better. And that's actually not true. So if I do an $80,000 chunk, right, I end up paying a couple grand more of interest. Okay. But if I do smaller chunks, it's not that bad. Now, here's the thing that we don't want to do necessarily. And again, the interest rate spread is not that much. But if you have a 3% mortgage and then you have an 8% line of credit, you'll feel it. But let's say I replace the mortgage with the line of credit, you'll see that here the I'm paying more than I have to, right? And which we don't want to do. But let me just do $6,000 chunks, and you see that we save. So the more closer the interest rate is from the loan to the line of credit, it's not that big of a deal. I mean, I personally always like to do the chunking method because it's very safe. However, okay, however, if the mortgage rate, like let's say you have an 8% mortgage and then an 8% line of credit, It's very safe to transfer that money because you're not going to miss out. Whereas if you have a 3% mortgage and then you transfer that into a line of credit, oh, it's so painful, right? We don't want to do that. Now, here we're just doing $6,000 chunks. Let's say I move this to $8,000, 8,000. You could see that the interest that you pay is just slightly increases a little because you are moving the debt from a high interest to low interest to high interest, and a line of credit will usually be a higher interest than a loan, right? Just because of the two-way feature, and so banks will price it appropriately based on the features that the debt product has, right? It's like software. Like Netflix has the free, or I don't know if it's like the low tier option versus like the higher tier option, but the higher tier option will always have more features, but we're taking advantage of the higher interest rate tool so that we can easily help pay off our debt and not segregate our income. Okay. So let me just go to 6,000 here. All right, so let me just 34 grand, 5.1 years. So let's just do this. And this is 44 divided by 12 plus 5.1. So 8.77 years debt free. 8.77 years debt free Thanksgiving. Thanksgiving. Actually, I don't like Thanksgiving in red. Let me make it green. Thanksgiving. Ah, why is my computer going crazy? Okay, so hopefully you'll be able to enjoy your debt-free Thanksgiving, and with your friends, relatives, feasting, you have meaningful conversations that are not stressful. Because most people, the number one reason why they're stressed is because of financial problems. And I always tell you the difference between rich people problems and poor people problems is that when you're rich, you can sleep at night, right? When you get rejected for having too much credit, when you apply for a business credit card application and the bank says, "Sorry, we can't give it to you. You have too much credit." That's like a rich person problem, right? I'm like, oh man, that really sucks, but I can go to sleep. Now let's just end it off with this, right? So let me ask ChatGPT. I just gave a velocity banking presentation on YouTube on Thanksgiving. Can you give some closing words for the audience after demonstrating paying off? How much did I pay off? See, I have a fish memory, so I don't even know how much. Um, $322,000 of debt, 322K of debt in 8.7 years. All right, I'm curious. Is it thinking? It's thinking. It's like the Dreamcast commercial.
Thank you all for joining me on Thanksgiving to explore the incredible possibilities of velocity banking. As we wrap up, I want you to imagine sitting down for a holiday like this, knowing your debt is behind you. $322,000 paid off in just 8.7 years. Think about the freedom, the relief, and the opportunities that come with that. This journey is about more than numbers. It's about taking control of your financial future and creating the life you truly deserve. If today inspired you, take the next step. Reach out with questions, share this with someone who needs it, and let's keep building a community of financial freedom. Thank you, and happy Thanksgiving.
Whoa, I love it. All right. Well, have a happy Thanksgiving, everybody, and hope to see all of your YouTube video uploads with your spreadsheets as well. All right. Have a great day. This is Korean Atlanta Mentorship.